joins us now, managing partner with Bering Private Equity Partners. Rahul, fantastic to have you back. Thank you for joining us. Exactly a year ago, it was all things in the fintech and the consumer tech space were looking exciting, charged up. There was a bit of a euphoria, and there was a lot of action. But exactly a year from last year, things are looking shaky. Promoters are talking about profitability. From growth, there is a realization which has come that shareholders in listed market ultimately care for cash flows and profits. Is there a change in the way how markets and promoters now would be looking at consumer tech, fintech, or the startup space?
Look, the fact that ultimately shareholders and all investors want cash flows is something which is a given. Right? When your cost of capital is so extraordinarily low, then what happens is that the cash flows which are promised or visible further down the line, they are almost equivalent to near-term cash flows, and then therefore there tends to be a lot of excitement about multiple business models which will promise you cash flows much further down the line. I think when cost of capital starts to go up, as it has in the last 12 months quite dramatically, then suddenly people are looking for much nearer term positive cash flows. And I think that has its impact on corporate decisions across the board. And I think it's a good thing. I think that we were getting a little excessive on the other side for a very long time. And I mean, our cost of capital, if you think about it, after the global financial crisis was close to zero for almost 15 years. And that creates all kinds of market distortions. And I think that going back to some kind of normalcy is good. I think there are also two other things that one needs to think about. And one is that there are structural drivers of returns and growth. And I don't think those have changed. I think that a lot of the disruption which is taking place, if one looks out 5, 10, 15 years, I mean, those disruption drivers are unchanged, and you're going to still have a movement of market share and the value capture in different businesses towards those disruptive technologies. But there is even cyclicality in that. If you look at, I'll use examples from the global market. But if you look at, say, Amazon, for example, they've had poor results just now, but the bottom line has got hit much worse because in the short term, they had anticipated much higher growth. So they had built out more inventory, built more warehouses, hired more people, and that growth didn't come. So the negative operating leverage has hurt them very hard. There is also inevitably when new businesses arise on the scene and they become very profitable, there is also pushback by regulators. And if you look around the world, regulators are going after the tech space, especially the companies which have been very successful and become very powerful. Now, this is true in terms of from the perspective of protecting privacy, which I think your Facebook has gotten impacted significantly on, or from the anti-competition and the competition commission kind of structures and architecture around the world, whether it's in Australia, which is just given a very hard time to Google and Facebook, or the European Commission, and even the Indian Competition Commission has recently fined Google because Google gives away the Android operating software for free, and then hooks in a lot of different kinds of Google products in there and controls the Play Store, in which they charge a commission for anybody who sells an app there. Now, all these were considered very revolutionary. They were everybody encouraged it, cheered it on. But when you reach that kind of success, then there's a societal cost which comes in, and I think that some of the very large players are sort of hitting that kind of speed breaker, I would say. But that doesn't change the fact that they're hitting that speed breaker because they have been so successful and become so dominant in their markets. And I think that for most investors, if their investee companies go down the trajectory where they become so successful that competition commissions, etc., need to worry about it, I think they've had a very good outcome anyway.
whether the global tech route has already spilled over to Indian IT names. A, of course, they're the listed services companies, and B, also what's happening within the new age tech companies slash e-commerce plays, you know, your Nykaa, PB Fintechs, Paytm, Zomatos, etc. Have these two sectors fallen enough to be bought again?
Look, on the services side, the reality is that if you look at, I'm forgetting who said this, but they said that software eats everything. I think it was Mark Andreessen of Andreessen Horowitz. Software will eat all other businesses. You are seeing that at several levels across many industries. The core competitive advantage is coming from frictionless exchange, which is driven by AI tools. It's coming from IoT devices, which is capturing big data and then doing preventive maintenance, or so all of it's really the competitive edge across many industries is software. So I don't see software slacking, especially because you also have a situation in the West, in spite of all the financial market cyclicality and all the issues up ahead, there are labor shortages. In the US, there's labor shortages. In most of the developed world, there are labor shortages. So I don't see our IT services industry being impacted very severely. Can there be a short-term blip? Yes, if somebody's cash flows are getting hurt very badly in a recession, people tend to cut back on spending, but that will inevitably be a short-term blip. I mean, I would think that IT services is in a good place and is going to stay in a good place for a long time. As far as the other high-tech sectors in India are concerned, and I think that's, whether it's all of the consumer names and the consumer-facing names, I think the real issue and the real challenge is that how much of the Indian market actually has the purchasing power. And, there's one thing, you're subsidizing people from, in changing their habits so that they adopt to your way of doing things. And you subsidize them to change their habits. It actually creates a valuable economic franchise and a sort of cash flow stream which you can present value, and it increases the value of your franchise. But if you're attracting customers who can't actually afford, they don't have the purchasing power to actually afford your product or service, and you're subsidizing them to bring them onto your platform, then they will continue to bleed you for a very long period of time. I think this one issue has, to my mind, not been fully addressed by the consumer tech players in the domestic market even now. And I think their boards really need to really look at this issue. And it's only after that happens that you will get stable, predictable, business growth and business outcome, and visible present value of cash flow, which investors will feel comfortable owning and holding.
Right. Rahul, morning. Wanted to also understand, given that you're pretty confident of the overall outlook for the IT services industry, saying that it is in a good shape and that is likely to continue, what is the outlook in terms of where is it that you see, what you see as one of the biggest concerns, or where you see pressure emerging? What would be the biggest concern?
I think, look, let's accept the fact that, global debt to GDP is so high, you are going to have dislocation. And when you start raising interest rates, and global debt to GDP is almost 4 times. It's between 3.5 and 4 times. You start raising interest rates, there will be a lot of people whose, interest payments as a percentage of the income will start to reach levels which they can't sustain. So you'll have asset sell-offs. You've already seen a massive asset sell-off in China in the housing market. I think that you will see something equally, if not equally, at least, quite brutal even in the American markets. And when you see these kind of sell-offs, people will get hurt. There will be short-term dislocation. Certain businesses will get hurt, and you will lose that business in the short term, right? So it's not that it's going to be a rosy one-way street. I'm just talking, if you take any kind of structural view on the sector, I think you're in very good shape. But expect volatility. I think with the deglobalization and the all the geopolitically driven dislocation of businesses. I think we are in for a bumpy ride, whichever direction and in whichever business. I think India is looking particularly benign at this moment because for whatever reason, we seem to be in a sort of camp which everybody feels comfortable doing business with. And the animosity between China and the West is going to definitely benefit us very significantly. I think if we get our act together, we would be in very good shape. And on top of that, we are actually in the stage of our cycle where a lot of the pain is behind us. The entire um, bad debt cycle, I think, in our banking system is behind us. There was some amount of bad debts which were built up during COVID times in microfinance and sort of lending to the weaker sectors. I think even that's largely been absorbed. And you've not had a capex cycle in India for a very long time. You add those things together, the entire
Correct.
banking system,
Yeah.
will see growth ahead.
Okay.
You see, strong
Yeah.
beta sectors like housing in India. Again, you're at the stage of the cycle where you're going to see long structural growth after
Right.
the
In
bigger.
fact, we've already started to see that, haven't we? When we look at the high beta banking names, if you look at what's happening with housing as well, we're running out of time. But Mr. Rahul Bhasin is always